We now move on to question number 1A, which carries 12 marks. Here you have to state with reasons whether the statements given to you is true or false. You get 2 marks for each, one for whether it is true or false, and second, the reasoning behind. You take up the first one. Trade discount is recorded in the discount column in triple column cash book. Now this is a false statement because trade discount is never recorded in the books of accounts. The second one, money measurement concept means transactions are to be recorded at a uniform monetary units. This is a true statement because all transactions should have monetary value in order to be recorded, in order to have comparability and uniformity. The third, if a society is a non-profit organization, has a separate trading account, the profit and loss from the trading account shall be transferred to the income expenditure at the time of consolidation. This is a true statement. It's a true statement because if it's a non-profit organization, but if it is making profits, then it has to prepare that in order to show what the profits are. The fourth one, partners in a partnership firm will share profits of business according to their capital contribution in the absence of any agreement. This is a false statement. Why? Because when there is no agreement amongst the partners, whatever be the contribution of the partners, they will share profits and losses equally. Now you go to LLP, should have 2 designated partners who are residents in India. This is a false statement. Yes, for a partnership you require 2 partners. But here, why is it a false statement? Because you require only one of them to be a resident in India. Both can be, but the requirement is only one. Then you go to the 6th one. A non-profit organization registered under Section 8 of the Companies Act. Mind you, it's registered under Section 8 of the Companies Act. Can distribute its surplus amongst the members. Now this is a false statement because when it's registered under Section 8 of the Companies Act, it cannot distribute this surplus amongst its members. We now take up question 1B. There are 2 sub-questions to it and each carrying 2 marks. The first is we have to state what is the objectives of the accounting standards. What are the objectives of the accounting standards? 1. Uniformity in accounting policies. 2nd, comparability of financial statements. 3rd, transparency and full disclosure. 4th, reliability. And 5th, protecting the interest of the stakeholders. So 5 points sufficient enough for stating what are the objectives of accounting standards because it carries 2 marks. Now coming to the second sub-question. What is the difference between liability and contingent liability? The difference between contingent liability and liability, but here they have stated liability and contingent liability. So first we take up liability. Now you can prepare it in a tabular form. First state what's the meaning of it. And second, state whether it's recorded or not. Now, first, liability. Liability is predetermined. It is fixed and it will have to be payable in the future. Whereas a contingent liability cannot be determined and therefore cannot be recorded. It depends on the happening or non-happening of a particular situation. Second important point is that a liability is definite and it is certain, whereas a contingent liability is uncertain. It depends, again, as I'm repeating it, on the happening or non-happening of a particular event. And now you need to give an example of it. For a liability, the example that you can give is creditors from whom you buy goods on credit. So it is determined, it's recorded in the books, and you will have to make the transaction, make the payment. Whereas in the case of a contingent liability, it is not certain, it's not recorded in the books. It depends on the happening or non-happening of the event. And the example is when you give a guarantee for a loan